Every trading course ever made will tell you the secret is a better strategy, a smarter indicator, a cleaner entry. They're all wrong, and they're wrong in the same direction. The real variable separating accounts that grow from accounts that blow up isn't what you trade. It's what you don't trade. The restraint nobody talks about. The discipline of watching a perfectly tempting setup form on your chart and closing the laptop anyway. I spent years bleeding money, taking trades I had no business being in, 23 trades in a single week, and only 5 of them belonged to my strategy. Those 5, 4 winners. The other 18 wiped out every cent of profit and then some. That was the moment I understood something that changes everything. Your job in the market isn't to trade, it's to wait until the exact conditions that give you an advantage finally appear. In this video, I'm going to show you exactly why patience is the most profitable skill in trading, how to build a system you can actually trust when the noise gets loud, and why the traders who master sitting still are the ones who last. Welcome to Trader's Bible, the quiet room for market mastery. Let's get into it. Let's start with something that sounds almost offensive when you first hear it. Profitable trading is boring. Not occasionally boring, not boring when the market is slow, boring as a design principle, boring as the goal. If you sit down at your charts and you feel that pulse, that low hum of excitement when a candle starts moving your way, that itch to get involved, that feeling that something is about to happen, I need you to treat that feeling as a warning signal, not a green light. Because here's what that feeling actually is. It's your brain releasing dopamine in anticipation of a reward. And your brain doesn't care whether that reward is profitable or not, it just wants the stimulus. It wants the action, it wants the hit. And the market, the most sophisticated wealth transfer mechanism ever built, is exceptionally good at providing just enough of that stimulus to keep you pulling the lever. Most traders walk into the market thinking they're analysts. They're not. They're slot machine players who've convinced themselves that their system is different. The charts are different. The indicators are different. But the core behavior, chasing stimulation under the guise of strategy, is identical.
When the shift you need to make is fundamental. Your goal is not to find action. Your goal is to execute a plan. And on most days, executing that plan correctly looks like doing absolutely nothing. No trades, no adjustments. No, let me just move my stop a little. Nothing. You open your charts, you assess whether your criteria are met, and if they're not, you close the laptop and go live your life. That is a successful trading session. That is discipline paying you in the currency of preserved capital. The market doesn't care that you've been watching for 3 hours. It doesn't owe you a setup because you showed up. And the moment you start trading out of boredom, the moment you start lowering your criteria because you need to feel productive, you're not trading anymore. You're gambling with extra steps. Now, I want to give you a mental model that changed how I think about all of this. Because concepts are easy to agree with and hard to apply, and what you need isn't just the idea. You need a frame you can actually return to in the moment when the impulse hits. Think about a lion on the African savanna. That lion doesn't chase every gazelle it sees. It doesn't sprint after the fastest one just to prove it can run. It doesn't burn energy on targets that aren't worth the effort. It sits. It watches. It reads the environment with complete patience and absolute precision.
And when it finally identifies the isolated target, the one that's separated from the herd, the one that's limping, the one that represents a high probability of success, it moves, not before.
Not because it's been sitting for a long time and feels like it should do something, only when the conditions are right. That is your operating model as a trader. You are not a participant in the market. You're a predator. And predators are selective by nature because they understand that energy is finite, capital is finite, and expending either on the wrong target doesn't just waste resources. It leaves you depleted when the right opportunity finally appears. Most traders are running the opposite strategy. They're sprinting after everything that moves. They're in 6 positions simultaneously. They're watching 5 different tickers. They're in Discord servers where someone posts a ticker every 40 minutes and the whole room piles in together. They're confusing activity with progress. They're confusing noise with signal. And your job is to define with extreme specificity what your high probability setup looks like. Not a general idea. Not, I look for support levels. I mean a precise, repeatable checklist. The kind of checklist where every box has to be ticked before a single dollar goes to work. And everything else, every pattern that's almost right, every zone that kind of looks valid, every setup that a different version of you might take, gets ignored completely. Because here's what most traders never do the math on. They know their win rate. Maybe they've back-tested and found it's around 60%. They feel good about that. But they never isolate the data between their in-strategy trades and their out-of-strategy trades. They never separate the disciplined executions from the impulse trades. Yet, and when you run those numbers, when you actually pull them apart, the picture is usually devastating. I did this with my own trading in the early years. I went back through 3 months of trades and tagged every single one in strategy or out of strategy. And what I found was this. My in-strategy trades were winning at around 62%. My out-of-strategy trades, the impulse entries, the boredom trades, the this kind of looks like my setup trades, were winning at 31%. Almost a coin flip, except worse, because I was usually taking worse entries on those trades, which meant my losses were larger and my winners were smaller. The impulse trades weren't just losing money directly. They were creating emotional debt that bled into my good trades. I'd take a loss on a boredom trade, feel frustrated, and then either overtrade to recover it or second-guess my next legitimate setup. The contamination spreads. One undisciplined trade doesn't just cost you that trade. It costs you the psychological clarity that your next real trade requires. Think about what that means mathematically. If your system, executed cleanly, produces one high-quality setup per week, 52 trades a year with a 60% win rate and a 1-to-2 risk-reward ratio, you're looking at meaningful, compounding annual growth. Not exciting, not viral, but real, sustainable, account-building returns. Now add 150 impulse trades into that same year. Suddenly, your effective win rate collapses. Your average risk-reward deteriorates because you're entering at worse prices. Your drawdowns deepen. And at the end of the year, you've worked harder, stressed more,
and made less or lost money, despite having a genuinely profitable system underneath all the noise. Fewer trades, executed better, will always outperform more trades executed carelessly every single time. The math isn't subtle about this. It doesn't depend on your specific numbers. It's a structural truth about trading that almost nobody acts on Because the alternative, sitting still while the market moves, feels psychologically unbearable. And that brings us to one of the most insidious forces in modern trading, one that didn't exist 20 years ago with the same intensity it does now. Social media. If you've been in the trading space for more than a few months, you've experienced this. You've had a setup. You've done your analysis. Everything aligns. You enter the trade with a clear plan, a defined stop, a realistic target.
And then, maybe out of habit, maybe out of boredom while the trade runs, you open Twitter, or X, or whatever we're calling it, or you check a trading Discord, or you watch a YouTube short from someone with 100,000 subscribers who's telling you the exact opposite of what your chart is showing. And something happens. A crack forms. Not because their analysis is better than yours, not because they have access to information you don't, but because certainty is fragile, especially early in your trading journey, and external noise is very good at exploiting that fragility. Suddenly, the trader you respect most sounds convincing. Suddenly, your own analysis feels uncertain, and you do the thing that costs you. You exit early, or you move your stop, or you flip your bias entirely. I want to tell you about a trade that cost me a very specific lesson. I had a short setup on EUR/USD. Everything was there. Strong supply zone, clear inducement swept, structure break confirmed. Fair value gap filled on the way down. I entered with a tight stop and a 1-to-4 risk reward. The trade started moving in my direction. And then I made the mistake. I checked Twitter while the trade was running, and there was a trader I followed, real following, real track record, articulate analysis, posting about how EUR/USD was about to break higher. Showing a long setup. His community was piling in. The comments were all agreement, and I panicked. I closed my short for a fraction of what I'd planned to make, convinced I'd missed something critical. My original target hit 18 hours later. A 4-to-1 return, sitting right there, fully available. If I'd just trusted what I'd already done the work to identify. That trade wasn't stolen from me by the market. It was handed back by my own inability to block out noise that had nothing to do with my system. Here's the rule I adopted after that, and it's non-negotiable. Once I'm in a trade, no social media, no financial news, no market commentary from anyone. My chart and my predefined plan are the only inputs that exist. Whatever I decided before I entered the position is the version of me that's most worth listening to. The calm, analytical version, not the version that's in a live position with capital on the line and emotions running. Other traders don't know your system. They don't know your criteria, your risk tolerance, your time frame, your account size. Their analysis is built for their system, their psychology, their goals. It's not built for yours. So why would you allow it to override the work you've already done? Your system is your compass. Everything else is weather. If this way of thinking about trading is landing for you, the patience, the selectivity, the idea that discipline is the actual edge, do me a favor and subscribe to Trader's Bible, hit the like button, and turn on notifications. Every video on this channel is built around the concepts that actually move the needle, not the surface level stuff you'll find everywhere else. It takes 2 seconds, and it genuinely helps the channel keep producing this kind of content. Now let's talk about the part of trading that nobody wants to sit with. The emotional part. A lot of traders treat emotions like a malfunction. like something to be suppressed or overcome. The goal becomes trading like a robot. No feeling, pure logic, mechanical execution. And while I understand the impulse behind that thinking, it's the wrong frame entirely. Emotions aren't the enemy, they're data. When you feel anxious before entering a trade, that's information. Maybe your position size is larger than your system actually supports. Maybe the setup is missing a criterion you're glossing over because you want it to be valid. Maybe you're entering near a major economic release, and part of you knows the risk is elevated. The anxiety isn't weakness. It's your pattern recognition telling you something isn't fully aligned. When you feel unusually excited about a trade, that's also data. Excitement in trading is often greed wearing the costume of conviction, or it often means you're seeing what you want to see rather than what's actually there. You're projecting a narrative onto the chart. And the more excited you are about a trade before it's even open, the harder it becomes to manage it rationally once it is. The skill isn't eliminating these emotions. It's creating space between the feeling and the action. You feel something and you acknowledge it, and then you run it through your checklist. Does this setup meet every criterion? Every single one, yes or no? If yes, you take it regardless of the emotion. If no, you don't take it regardless of the emotion. The emotion never gets a vote on the actual decision. It only gets acknowledged. The practical tool that makes this possible is the trading journal. And I don't mean a spreadsheet with entries and exits. I mean a real log. Before each trade, what does the setup look like? What are you feeling? Why are you taking it? During the trade, are you tempted to interfere? And why? After the trade closes, what actually happened? What would you do differently? What did you do well? Over time, this journal becomes the most honest mirror you have as a trader. You'll start to see your patterns clearly. You'll see that you overtrade on Tuesdays after a winning Monday. You'll see that your worst trades happen in the last hour of the session when you're tired and just want something to happen. You'll see that 3 consecutive winners makes you reckless, that the confidence tips over into overconfidence, and you start giving yourself permission to bend your rules. I identified one of those patterns in myself years ago. After 3 winners in a row, and I consistently made poor decisions on the 4th trade. Not always a loss, but the process was worse. The criteria were looser, the position size was bigger, the entries were sloppier. So I created a rule that has nothing to do with the market and everything to do with managing myself. After 3 consecutive winners, I take a mandatory 24-hour break from the charts. That's it. Not because 3 winners means something is about to go wrong. Not because the market changes after I win 3 times. But because I change. My psychology shifts. And that shift has historically cost me more than the break ever will. Same principle after losses. After 2 consecutive losses, I stop trading for a minimum of 12 hours. I review both trades, not to catastrophize or tear apart my system, but to answer one simple question. Did I follow my rules? If I did, the losses are just probability playing out, and there's nothing to change. If I didn't, I need to understand why before I put any more capital at risk. These aren't trading rules. They're psychological operating rules. And they're every bit as important as anything on your entry checklist. Now I want to talk about something that very few people who teach trading actually say clearly, because it doesn't sell courses, and it doesn't generate excitement. But it's the most important framing you can have, especially if you're early in this journey. The first years of trading are tuition, not returns. Tuition. You are not supposed to be making significant money in year 1 or 2. You are supposed to be learning, building a system, testing it, failing in manageable ways, yet discovering your psychological patterns, developing the discipline that profitable trading actually requires. The traders who treat this phase as their education survive it. The traders who treat it as a wealth-building period blow up their accounts and quit. We live in a world that has completely restructured our relationship with time. Everything is immediate. Food arrives in 30 minutes. Information arrives in milliseconds. You can watch 10 hours of content in an evening and feel like you've consumed a decade of knowledge. And that rewiring of expectation is catastrophic for trading, because trading doesn't respond to urgency. It responds to patience. The market has no mechanism to reward how hard you want it, how long you've been watching, or how badly you need a win right now. What it does reward over time, and with compounding mathematics that are genuinely extraordinary if you let them run, is consistency. Boring, disciplined, rule-following consistency. Let's make the math real. Start with $10,000. Generate an average of 3% per month, not by taking massive risks, but by executing a solid system patiently and well. After year 1, you have around $14,000. Not impressive. After year 3, you're approaching $29,000. After 5 years, nearly $60,000. After 10 years, you're looking at over $340,000. From a $10,000 starting account, doing almost nothing except following your rules and waiting. Now run the alternative scenario. You start with the same $10,000. You have a great first month, 15%. You feel like a genius. Yeah, you increase your risk. You start taking more trades. Month 2, you lose 20% of your now elevated account. You're back below where you started. You panic. You try to recover it fast. You blow up. You deposit another $10,000 and start the cycle again. 5 years later, the patient trader has $60,000. The impatient trader has deposited $50,000 total and has nothing to show for it. Or worse, has less than nothing after commissions, spreads, and blown accounts. The variable between those two outcomes isn't intelligence. It isn't strategy. It isn't access to better information or better tools. It's the willingness to let the compounding work, to not interrupt it, to not blow it up. Chasing a result, the math was already going to deliver if left alone. Set your alerts. Walk away from the screen.
You measure your success, especially in the early years, not by how much money you made, but by how faithfully you followed your rules. That is the metric that actually predicts long-term results. That is the number worth optimizing. Because here's the final thing I want you to sit with before we move into the specifics of building a system you can actually trust. The traders who survive this long enough to see the compounding work, the ones who make it to year 4, year 5, year 7, they all say the same thing when you ask them what changed. It wasn't a new strategy. It wasn't a better indicator. It wasn't a mentor, or a course, or a magic piece of software. It was learning to do nothing. Purposefully, patiently, professionally. They stopped measuring a session by what they traded and started measuring it by what they protected. And they stopped treating the market like a place to find action and started treating it like a place to execute a plan. Occasionally, precisely. and only when everything was right. And speaking of building a system you can actually trust, one that gives you that kind of conviction, that's exactly what we're going into next. The patience, the discipline, the emotional regulation, none of it holds without one thing underneath it. A system you've proven to yourself actually works. And that's where most traders are building on sand. Here's a question worth sitting with, honestly. When you're in a trade, and it starts going against you, when price is moving away from your entry and your stop is getting closer, what do you feel? Most traders will say anxiety. Some will say fear. But if you dig one layer deeper,
what's usually underneath both of those emotions is something more specific. Doubt. Not doubt about this particular trade, doubt about whether your system was ever real in the first place, doubt about whether the edge you think you have is actually there, or whether it's just a story you've been telling yourself to justify sitting in front of charts every day. That doubt is expensive, because doubt in a live trade almost always leads to the same outcome. You interfere. You move your stop to give the trade more room. You close early to protect a small profit that your plan never intended to take. You flip your bias entirely because someone on the internet said something that sounded authoritative. And then price does exactly what your original analysis said it would, without you in the trade to benefit from it. Yet the antidote to doubt isn't confidence as a personality trait. It's not telling yourself you're a great trader or visualizing success or any of the motivational framing that gets sold alongside trading courses. The antidote to doubt is data. Specifically, it's your own data, gathered from your own system, tested across enough market conditions that the results stop being a question and start being a known quantity. This is what backtesting actually is. Not a formality you perform once to feel legitimate, not a quick scroll through historical charts to see if your idea looks right, but a rigorous, documented, repeatable process that tells you, with genuine statistical confidence, exactly what your system does over time. And most traders skip it almost entirely. They find a strategy they like. Maybe from a YouTube video, maybe from a course, maybe from a trader they respect. They demo trade it for 2 weeks, decide it feels good, and move to live capital. 2 weeks, maybe 30 trades. That is not a sample size. That is not evidence. That is pattern matching, dressed up as validation. And it will collapse the moment the market enters a condition those 2 weeks didn't cover. Proper backtesting means going back years. It means pulling up the daily, the 4-hour, the 1-hour across multiple instruments and finding every single setup that met your criteria. Not the ones that look clean in hindsight, not the ones you'd obviously have taken, but every setup, including the ones that were ambiguous, including the ones that lost cleanly, including the ones that hit your stop and then reversed immediately. Every single one. You record the entry, the stop, the target, the result. You track your win rate. You track your average winner relative to your average loser. You track your maximum consecutive losing streak, because that number, specifically, is the one that will save your psychology during a drawdown. And you track your profit factor, which is simply the ratio of your total gains to your total losses. Anything above 1.5 suggests a genuine edge. Above 2.0, and you have something worth building on. When I went through this process properly for the first time, not a surface pass, but a real multi-year, multi-instrument audit, it took me 3 months. 3 months of evenings and weekends, marking charts, logging results, questioning criteria, refining definitions. It was tedious. It was the opposite of exciting. And it was the single most valuable thing I've ever done as a trader.
Because at the end of it, I didn't just have a strategy. I had proof. I had hundreds of data points telling me what my system does when it works, what it does when it fails, how long losing streaks typically last, how quickly it recovers, what market conditions it performs best in, and what conditions I should sit out entirely. And that proof changed everything about how I trade. When I hit a losing streak now, 3 losses, 4 losses, even 5, I don't spiral. I don't start questioning whether the whole approach is broken. I pull up my backtest data and I see that I've had streaks of 7 consecutive losses in historical testing, and that after every single one of those streaks, the system came back. The edge is real. I've seen it across thousands of examples. A losing week is not evidence of a broken system.
It's just probability doing what probability does. That's the kind of conviction you cannot buy and cannot fake. You can only earn it through the work. Now, there's a step that comes after backtesting that most traders either skip or rush, and it's just as important. Forward testing, also called paper trading or demo trading, where you apply your now documented, now proven system to live market conditions in real time without live capital. The reason this matters is that back testing, however thorough, is inherently retrospective. You're marking charts where you can already see what happened next. Even with the best intentions, there is a bias that creeps into the process, a slight tendency to be more generous with ambiguous setups that worked, more dismissive of setups that didn't. It's human.
It's almost impossible to eliminate entirely. Forward testing removes that. You're now making decisions in real time without the benefit of seeing the next candle. You're experiencing the uncertainty that live trading actually feels like. The setup that looks perfect until a news release drops 20 minutes after your entry. The zone that holds for 4 hours and then breaks on the 5th. The trade that runs immediately to target while you're second-guessing whether it was really valid. All of that texture, all of that real-time psychological pressure shows up in forward testing in a way it simply cannot in back testing. Do this for a minimum of 3 months before moving to live capital. Not 2 weeks. Not 1 month because you had a good run. 3 months across different market conditions, logging every trade with the same discipline you'd apply to a funded account. If your results in forward testing broadly reflect what your back test suggested, you have a system worth trading live. If they diverge significantly, if your win rate in real time is meaningfully lower than backtesting implied, that's information. That's telling you something about your criteria that needs refining before real money goes to work. The traders who skip this step almost always pay for it. They find out in real time with live capital, under real emotional pressure, that their system has gaps they didn't know were there. And by the time they've gathered enough data to understand those gaps, they've already taken the financial and psychological damage that comes with discovering them the hard way. Protect yourself from that by doing the boring work first. But here's something I want to address directly, because I see this mistake constantly in trading communities. Backtesting and forward testing will give you the data.
What they won't automatically give you is the right system to test in the first place. And this is where a genuinely important distinction lives. The difference between trading someone else's system and building your own. There is an enormous industry built around selling trading systems, courses, mentorships, Discord groups, algorithmic signals, alert services. The supply is infinite and the marketing is extraordinarily good. And the pitch is always some version of the same thing. Someone else has already done the hard work. Here's the shortcut. Follow these rules and capture the results. I bought into this.
More than once. And I'm not saying the educators selling these systems are fraudulent. Some of them are genuine traders with genuine edges. But here's the problem that nobody in that industry has an incentive to tell you. A system you don't fully understand will fail you the moment it's tested. Not because the system is broken, but because when you hit a losing streak, which you will, because every system hits losing streaks, you have no foundation to stand on. You don't know why the system works. You don't know which conditions it performs best in. You don't know whether this particular losing streak is normal variance or a signal that something structural has changed. And without that knowledge, you do what every trader does when they're losing and they don't understand why. You abandon the system, go looking for a new one, and repeat the cycle. I followed a trader for 3 months once, experienced, respected, with a large following and a documented track record. His system required watching charts for 8 hours a day, making rapid decisions based on fast-moving price action on lower time frames. It was technically sound. His logic was coherent. But it wasn't built for how I think, how I live, or how I process information. When I was in a trade using his system and something unexpected happened, I had no independent judgment to fall back on. I was trying to think through his eyes instead of my own. And when the losses came, as they always do, I had no conviction to hold on to. So I stopped. Went back to first principles. Spent months studying price action, market structure, institutional order flow, supply and demand. Not to find a new system to copy, but to understand the underlying mechanics well enough to build something from the ground up. Something I could explain every element of. Something where every rule had a reason I understood, not just a rule I'd been told to follow. That process took longer. It was less comfortable than buying a roadmap. But when I came out the other side, I had something that no course could have given me. Genuine ownership of my approach. I knew exactly why I was looking for a strong impulse move before considering an entry. I knew exactly why inducement needed to be cleared before I'd trust a zone. I knew exactly when my system was and wasn't in its preferred environment. And that knowledge, that deep, earned understanding, is what allows you to sit through a losing streak without abandoning ship. Your system has to fit your life. Now, this is something that almost nobody talks about, but it matters more than most technical details. If you have a full-time job and can only check charts in the morning and evening, a scalping strategy that requires watching the 1-minute chart for 6 hours is not your system, regardless of how profitable it is for someone else. If you're naturally a deliberate, methodical thinker who needs time to process information, a fast execution approach that rewards reflexes over analysis is not your system. If you're highly sensitive to drawdowns psychologically, a system with a 30% maximum drawdown, even with excellent long-term returns, will break you emotionally before it pays you financially. The right system is the intersection of what works in the market and what works for you. That intersection is different for every trader.
Oh, finding it requires experimentation, honest self-assessment, and time. But once you find it, once you've tested it rigorously and built genuine conviction in it, the whole experience of trading changes. The noise quiets down. Not because the market changes or social media stops being loud, but because you have a reference point that's stronger than the noise. Someone on Twitter says EURUSD is going to explode higher. You check your chart. Your criteria aren't met. You do nothing. Not because you're rigidly ignoring information, but because that information isn't relevant to your system. And your system is the only thing that determines whether you trade. That's sovereignty. That's what it feels like to trade with genuine conviction, rather than borrowed confidence. And there's one final piece to this that I want to leave you with before we close out. Building a system and testing it thoroughly is the technical foundation. But trading is performed by a human being, in real time, under uncertainty, with real money on the line. And human beings need structure around them, not just analytical structure, but daily operational structure to perform consistently over long periods. The traders who last aren't just the ones with the best systems. They're the ones who've built lives that support their trading. They have routines. They have hard rules around when they look at charts and when they don't. They have defined cutoff times so that trading doesn't bleed into every hour of every day. They exercise. They sleep. They maintain relationships and interests outside of the market. Because isolation and obsession are the fastest routes to the kind of psychological fragility that destroys trading performance. I check my charts 3 times a day at predetermined times. I mark levels, set alerts, and walk away. I have a cutoff time after which I don't look at a single chart regardless of what's happening in the market. I review my journal every Sunday for 20 minutes, and I measure each week not by my P&L but by how cleanly I followed my process. That structure isn't a restriction. It's what makes consistent performance possible. It removes the decision fatigue of constantly asking yourself whether you should be looking at the charts right now. It keeps trading proportionate in your life, so the pressure stays manageable. And manageable pressure is the environment in which good decisions get made. And the market will be there tomorrow, it will be there next week, next year, a decade from now. It has no closing time and no finish line. The urgency you feel, the pressure to be in something, to be doing something, to keep up with everyone else who seems to always be trading, that urgency is manufactured. It's not real. And the sooner you stop responding to it, the sooner your actual results start reflecting the quality of your thinking, rather than the volume of your activity. Build your system. Test it until you have proof. Structure your days so that waiting feels like work, because it is. And when your setup appears, exactly as your criteria define it, with no compromises and no exceptions, strike with everything you have. That's the whole game. You clicked on this video expecting to learn about timing the market better.
Maybe a cleaner entry technique. Maybe a way to identify setups faster, act quicker, stay sharper. What you actually learned is that the edge was never in the action. It was always in the restraint. The traders bleeding out quietly every month aren't losing because their strategy is wrong. They're losing because they can't tolerate stillness. They've confused movement with progress, activity with skill, and busyness with professionalism. The market didn't take their money. Their impatience handed it over. What this video asked you to consider is a complete inversion of how most people approach this. That profitable trading is deliberately boring. that your emotions aren't obstacles, they're a diagnostic tool, and most traders never learn to read them. That a system you've borrowed from someone else will collapse under the first losing streak, not because it's broken, but because you never truly owned it. That the compounding that builds real wealth doesn't need more trades. It needs fewer interruptions. And that the urgency pushing you toward the screen right now, the feeling that something is happening and you're missing it, that feeling is the product, not the signal. The traders who last aren't the most active ones in the room. They're the quietest, the most deliberate, the ones who've done the unglamorous work of back-testing, journaling, and building structure around their days, not because it's exciting, but because they understand what consistency actually costs. Before you open your charts next, ask yourself one honest question. Am I about to execute my system, or am I about to respond to a feeling? The answer to that question, repeated over hundreds of sessions, is what determines everything. This is Trader's Bible. We'll see you in the next one.